Bruce Blythe with Vance Publishing. I'm at an agricultural conference sponsored by DTN and Rabobank held in downtown Chicago. Chicago's ag market's under pressure much of this week, and the USDA added to that bearish momentum earlier today with its latest monthly supply and demand update. The USDA hiked its estimate for U.S. corn stockpiles at the end of next summer by 5 million bushels to 848 million bushels, contrary to trade expectations for a cut of about 12 million bushels. And that set corn futures down this morning, with March down about 9 cents at around $5.90 a bushel. USDA also hiked its estimate for global corn production over the coming year by about 1% to a record 867.5 million metric tons, primarily because of bigger crops in China and in Europe. And they also raised their forecast for ending global stocks of corn by almost 5%. So overall, it paints a picture of a supply outlook that's loosening up a bit, not quite as tight as we feared a few months ago. And the old saying, high prices cure high prices, that's what's happening as other global producers of corn are ramping up production. Now, I also sat through a presentation by Darren Newsom this morning, who's an analyst with DTN. He thinks there could be more downside in corn prices. He says the commercial side of the market is getting more comfortable with the supply outlook, and we could be testing the $5.50 level in corn futures over the next few months. However, he does not see a huge increase in corn plantings next spring. He thinks we may be around 92 million acres, similar to last year. And longer term, the market could test resistance around 675 to 715, but probably not revisit the 2011 highs. We may have confirmed a long-term top with the record highs we saw earlier this year. Once again, Bruce Blythe with Vance Publishing.